Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody. I'm so excited for today's conversation. We're going to have a fantastic podcast. With us, we have Justin Drake, who is a researcher at the Ethereum Foundation and one of the voices that can clearly tell us about the merge, how it works, what's going to happen. And we're going to dive into that and the implications for Ethereum and Web3. Justin, welcome to the podcast.
Thanks for having me, Lex.
My pleasure. So I want to start off with a little bit of your journey into crypto, into Web3, before we get into the really hairy technical stuff. How did you get engaged on these ideas? What were some of your early experiences with crypto economic systems, and what caught your imagination?
Right. So I actually got involved in 2013 thanks to a friend called Dankrat. And you might know Dankrat because there's Dank sharding, which is named after him. So we used to work together in a small company in Cambridge in the UK. So that was mid-2013. And then towards late 2013, I really fell down the Bitcoin rabbit hole. And I started the Cambridge Bitcoin Meetup group. And with Dankrat, we also set up a Bitcoin ATM where we were selling Bitcoin for cash in Cambridge. I also tried to build a startup on top of Bitcoin. I could really see the long-term vision of building out decentralized financial infrastructure. And one of the exciting things that was being built on top of Bitcoin was this idea of a decentralized peer-to-peer marketplace called OpenBazaar. And so the concept was to try and build an internet equivalent of eBay without eBay, the company itself, right? Because on eBay, you're buying and selling stuff from peers, but you're intermediated by this company that adds a lot of friction, right? They haven't innovated in a long time. They charge high fees. They have all sorts of constraints on what you can buy and sell. And so the question was, could we build a decentralized equivalent on top of Bitcoin? And it looked like the answer was maybe. What you can do on Bitcoin, for example, is build what are called escrow contracts. So you can have these 2 out of 3 multi-sigs where you have 3 different parties. You have the buyer, you have the seller, and you have the escrow. And if 2 of these are wanting to spend the funds that are locked in escrow, then all is good. And so the idea was that the buyer and the seller would kind of agree on a mutually trusted escrow, which doesn't have to be, eBay. It could be anyone else. And so it was this idea where you kind of unbundle the whole stack of eBay, because eBay provides many different services, right? It provides escrow services, it provides insurance services, it provides payment services, it provides identity, reputation, and many other things. And really, it was kind of this early vision of money Legos, right? Because now on Ethereum, we talk about money Legos like Uniswap. There was this primitive version of identity on Bitcoin, which it became the Stacks project. And, we were asking ourselves, could we put all these money Legos together and build a decentralized peer-to-peer marketplace? And in hindsight, I think we were, at least a decade too early. My startup and OpenBazaar didn't do so well. And that's where I looked for other opportunities in the broader crypto space, because back then it was only Bitcoin, other than this very nascent project called Ethereum. And the exciting thing about Ethereum for me as a perspective, from my perspective, building on top of Bitcoin, was that it's programmable, because we were really pushing the limits of Bitcoin as to what it could do in terms of its very primitive programmability. And so Ethereum was this breath of fresh air. And so I, was attracted to it. And what happened is that I saw a talk by Vitalik on the data availability problem. And I spent a few weeks thinking about this very fundamental problem. and had some ideas. I emailed him, and we had a good email conversation. And a few weeks later, I joined the Ethereum Foundation as one of the early researchers. Back in 2017, when I joined, there was maybe a handful of researchers. When I came in, I expected there to be like this really robust R&D team working on this like mega, tens of billions of dollars project. But really, it was kind of this ragtag team of a handful of very, very smart and visionary researchers, but not super professional in the R&D.
The visual image I would get is the garage in which Apple was born, or the early days of Amazon in Bezos' office, or the early work of Google. You expect these gigantic companies and these gigantic outcomes to have always been monolithic, but of course that's not true. It takes an immense amount of risk-taking and really thinking outside the possible to get there. It probably would have been hard to see that, to recognize the importance of this stuff, if you hadn't tried to brute force decentralized software on top of Bitcoin and come up against those challenges. And I think there's this key of like, what is decentralized money and what do you need for money to be transformed or for a currency to work, and how different that is from actually creating an economy and replacing an eBay, replacing a Facebook, or evolving those functionalities. I want to just meditate on this point for a second and ask you, like, what is decentralized software in those days when you were kind of coming up against the idea of replacing an eBay? Like, how did you think about a software made of software rather than of people?
Right. So as you said, we have this piece of software that in a way abstracts the hardware. Like traditionally, you have two layers in the stack. You have the hardware stack and you have the software stack. And by kind of decentralizing the hardware stack, we kind of abstract it away and make it irrelevant. And this gives us a couple of things. Like one is that it gives us this extremely strong robustness. This idea that decentralized systems are here to live on for decades and centuries with strong censorship resistance, basically strong liveness, but also strong safety in the sense that these blockchains are immutable and the history that gets written there won't change. And then the second aspect that was really exciting to me was this idea of permissionless innovation, this idea that anyone can come in, just like the early days of the internet. You could be a 12-year-old in India and that's fine. And, if we go back to this eBay analogy, if you wanted to innovate on top of eBay, what was the process? Well, you'd have to fly to California, put on the suit, meet with the executive team, show your slide deck, convince them of the financials, and kind of build out, an internal engineering team. And it was this hugely expensive process full of friction. Whereas with permissionless innovation, you have this permissionless composability as well. There's the aspect that companies are silos, right? They don't want to compose with the world because you potentially leak out value. Like the way that you capture value is being as siloed as possible and kind of grabbing as much of the market for yourself and not for competitors. And it's kind of decentralized systems kind of invert that logic. One of the things that going back to Bitcoin and permissionless innovation, I could really see this vision, and there was this group of people within the Bitcoin community who actually believed that Bitcoin could upgrade over time to become more programmable. And I think this is one of the reasons why we persisted so hard to build on Bitcoin. Like we were pushing it to the limits, but we had this belief that the limits would grow over time, the bleeding edge would evolve. But actually, it turned out that there was this schism within the Bitcoin community. There was kind of the evolvists, as it were, who believed that Bitcoin could evolve. And there was the stagnatists, those who believed that Bitcoin must at all costs stagnate and ossify. And in a way, Ethereum is not just a fork of Bitcoin technically, which basically adds more programmability, but it's also more of a philosophical one as well, where we're saying we're going to embrace pragmatism and innovation above dogmatism and stagnatism.
When you were talking about the ability to remix business logic without having to put on a suit, it's like the hip hop approach or like the DJ approach to music. You know, you can take anything and just make a new, fresh thing without having to go to those that would give you, you know, IP rights or whatever it is, and you can just create. You joined the Ethereum Foundation as a researcher, and you've been focused on this over the last 4 or 5 years, which is almost the entire life of the protocol. What does it mean to be a researcher for Ethereum? Like, how do people work on it? You know, is there some high tower that you ascend to in order to do it? Like, what's the process for working on the protocol, for upgrading the protocol, for pushing code updates? How does it work?
Right. So a quick note on me joining in 2017. When I joined, I felt like I was extremely late. Right, the project had already launched. The market cap was already fairly large. I felt that it was a massive project underway. And I think there's this perpetual feeling of being late. Like when I joined in 2013, for example, I felt very late in the Bitcoin game. You know, it's a pattern that I see over and over again, whether you come in 2015, 2017, 2019, whatever it is, you always feel late. But in the grand scheme of things, we are extremely early. And still today, we are very, very early. In terms of how the Ethereum Foundation works and how research works there, it has evolved over time, over the 5 years that I've been there. Like as I said, you know, in the early days, it was a small team and the designs were extremely early. So to a large extent, we were doing this blue sky research where we had few constraints. We just had these fairly well-defined open problems, specifically proof of stake and sharding. And the question was, what are the best crypto economic gadgets that we can build in order to solve these open problems? And it allowed us to move pretty fast on the research side of things. And we actually made like several pretty big breakthroughs over the years. There's this experience of, you know, being pretty satisfied with the design that we had, for example, in 2018, and then suddenly finding a 10x breakthrough. And then kind of, because we found this breakthrough, we kind of went down a new rabbit hole. And then in 2019, we found another 10x breakthrough. And then in 2020, we find another 10x breakthrough. And so when you zoom out, even though it looked like in 2017, 2018, we had reasonably good designs, in hindsight, they're crap designs compared to what we have in production today. So that's kind of the research phase. And one of the things that we did was also like try and grow and professionalize the team. So back when I joined in 2017, there were about 5 people. Now there's about 25 people in the research team. We're more structured now. So we have these sub-teams. So for example, we have a cryptography sub-team because to a very large extent, we leverage cryptography as a tool to build these crypto economic gadgets. We also have basically an incentives team, what we call the robust incentives group. And they kind of look at the other side of the question, which is the economics. We also have a security team. And I'll talk about this more in the context of how we actually go implement the designs and the specs that we've written. And then we also have this basically what we call the specs team. So the specs team is the team that I'm part of. And in a way, we kind of straddle all the teams and try and bring everyone together to have like a consistent and holistic spec that is both, you know, secure and audited and high quality. Basically, this is where the remit of the research team ends in a way, is like delivering these specs. So from a technical perspective, we don't go that much further, and then we kind of hand over to the devs. And it turns out that the devs are organic teams all around the world that have volunteered to go implement these specs that we've helped write. And so you can think of it a little bit like IETF and the internet. So IETF stands for Internet Engineering Task Force, and it's kind of this body that is going to standardize the big internet protocols like IP, TCP, DNS, SMTP, etc. And then these big internet protocols then get implemented by browsers like Safari, Firefox, etc. And so when you look at the client landscape like Prism, Teku, Lighthouse, etc., they're basically equivalents of browsers that have organically sprung up. to go implement the spec. And so our role as researchers, in a way, is to coordinate. We stop to a large extent doing like hardcore technical research, and we basically become this coordinator between the many different teams. So we're coordinating between the implementation teams. There's 5 of them, 5 consensus clients. We coordinate also with the execution teams, because the merge is all about bringing these 2 teams together. We coordinate with security auditors. We coordinate with cryptographic implementers. So one of the challenges of cryptography is that it's pretty compute intensive. The optimizations are extremely difficult to do because you have a desire for both performance and security. And so we've been working, for example, with a company called Supranational that basically is specialized in implementing this super high quality cryptographic libraries. But, we also work with security researchers who will do formal verification of these libraries to make sure that these libraries are bug free, essentially.
I've got one more question before we get into the merge and the protocol's upgrade or transition. Maybe it's a philosophy question, I don't know, but it's about the structure of governance or growing the protocol or adding to the protocol, and there are some projects, let's say maybe Bitcoin is the extreme version of it, where development is, in a sense, chaotic and political between the people that contribute to it, the developers that contribute to it. And then, there's kind of power games between that and the miners and so on. There's organic approach to creating a roadmap and governance and evolution of the protocol. And then on the other side, there are some blockchain layer 1 projects and of course, lots of decentralized applications that have a much more formalized governance approach and often connect crypto economics to voting and connect voting to protocol and product upgrades. And so everything is much more deterministic in terms of how versioning happens and so on. How do you think about how do those choices relate to the protocol's ability to be anti-fragile, its ability to evolve? What are the trade-offs and where's Ethereum there?
Right. So one of the things that I like to distinguish is this idea of machine consensus and social consensus. So they're kind of 2 layers of the consensus stack. The machine consensus, as the name suggests, is kind of operated by machines, and it runs on the order of seconds, right? So every 3 seconds, you can have a block, for example, and you can have attestations come in. And this type of consensus is fully automated, and it's using cryptography, and it's also using basically economic weight. So this scarce resource, may it be hash rate or may it be stake, to drive this machine consensus. And then there's this other layer of the stack, which I call the social consensus, which is part of the social layer. And that's it runs on the order of weeks because it's ultimately run by humans. And humans are slow and it's a messy process. It could be contentious. That makes it very expensive. But the realization to me, a few years ago was that ultimately the social consensus is in control, right? It's in control over the machine consensus. And the reason is that the social layer sets the rules of consensus, specifically machine consensus. So the machines can only operate within the bounds that they're given. So just to give a very simple example, the machine consensus can't just include invalid transactions. So if a transaction were to just mint millions and millions of ether out of thin air and give them to the machine consensus participants, then that would basically create an invalid fork, which would be completely illegitimate and ignored by the social layer. And I think one of the things that we've done pretty well is basically try and preserve the richness of the social layer. So you can ask yourself, who exactly within the social layer is part of consensus? And the answer is that it's everyone and no one. It's simultaneously the researchers, the developers, but it's also everyone running a node, the block explorers. It's the validators as well. It's the exchanges. It's the stablecoin custodians. It's the DeFi builders and the dApp builders and the users as well, and the wallets and the interfaces. It's everyone at the same time. And I think one of the things that you risk jeopardizing if you try and basically codify this social consensus within the machine consensus is that you project and you lose a lot. And like one of the things that some projects do, for example, is this idea of having the validators basically vote on, or either the validators or the whole set of token holders basically vote on new rules for the machine consensus. But the problem is that if you only look at the token holders, like you're missing out 90% of the richness of the social layer. And you basically, become a plutocracy where, the rich and the economically wealthy have the power to largely dictate the machine consensus. I mean, in a way, you kind of create three layers, right? Because you create the machine consensus, and then you have the token holders, and then still you always have the social layer who can override. But if you have this fast path for the token holders, then there's kind of this expectation that becomes the default, and so you start eroding some of the sovereignty of the social layer.
I think that by aligning economic token voting with, some idea of utility, or giving it so much power as to actually determine the roadmap and the product, you're making some pretty deep assumptions about who matters, who expresses their views, and those assumptions don't necessarily fit well with how societies actually operate or what makes people happy. And end of the day, these are systems for people. Let's transition to the topic of the merge. Just start by laying down kind of the fundamentals. What are the main elements that we should think about? What is happening, and then what is not happening in the merge? For example, people are going to be confused about withdrawals. They're going to be confused about the tokens. They're going to be confused about scalability. Let's just define what is going on and in what time period.
Sure. So the merge is all about engines. I want you to picture a car, which is Ethereum, which is moving forward. And the only thing that we're doing is we're upgrading the engine. And so we're not changing the steering wheel, we're not changing the wheels, we're not changing the chassis or the color of the car or anything like that. It's only thing we're doing is like under the bonnet, under the hood, we're swapping one engine to another. And if you want to extend this analogy, this metaphor, you can think of upgrading from a gasoline engine to an electric engine. And like you may ask yourself, why would we want to change our engine, our consensus engine, from proof of work to proof of stake? And the reason is that the engine is just so much better. Like, Bitcoin came along and they had this steam engine, as it were, and we've made a bunch of innovations, and we have this like really futuristic electric engine. I guess the next question becomes, what properties of consensus engines do we care about? What are we optimizing for? And it turns out that blockchains, the product that they provide to humanity, is called secure block space. It's this kind of digital substrate where people on the internet who don't necessarily trust each other, can come together on this credibly neutral platform to perform transactions of value. And so one of the key things that we're optimizing for is security. And it turns out that this engine, this new engine, is just orders of magnitude more secure. On the one hand, it has more economic security. So economic security, you can kind of think of it as the size and the power of the engine. So we're just putting in a much beefier engine, which is going to be much harder to 51% attack. And there's this other kind of amazing and underrated property of this engine, which is basically healing. It's this idea that if there is an attack, if there is a 51% attack, and the engine breaks down and the car kind of stops, then we can call a mechanic, and the mechanic will heal the system. And the mechanic here in this case is the social layer. We can ask the social layer to intervene and basically fix the engine. And this is something that we can't do with proof of work. In a way, with proof of work, the machine consensus is the end all be all. And if it turns out that the machine consensus is compromised, then we can't easily have the social layer come in and intervene. Another property that you might care about secure block space is like how much secure block space do you have? But it turns out that we're the merge that's kind of orthogonal to the engine, right? So there's kind of two layers of the stack here that are relevant. There's what we call the consensus layer, and this is what the merge is all about. And there's the execution layer, which is a separate layer. And we're not touching the execution layer. And so this is actually reflected in the type of nodes that you'll be running if you want to be a full Ethereum node. Previously, before the merge, you'd run a client, for example, Geth, and we call that the execution client. And so what is Geth's main job? Well, basically, it's to maintain the Ethereum virtual machine, the EVM, and process all these Ethereum transactions and maintain the Ethereum state. And the other thing that it does, maybe like 1% of its code base is the consensus stuff around proof of work. And it turns out that proof of work is so simple. It's almost like a footnote in the Geth code base. And basically what we're doing is that we're removing this tiny portion of the Geth code base around proof of work, and we're replacing it with a full new, fully fledged consensus client. So one of the things about proof of stake is that it's significantly more complicated. So that's kind of one of the fundamental trade-offs of innovation, is that you get much better systems, but they are like fundamentally more complicated. A little bit like an iPhone is just so much more complicated than one of these prehistoric phones that that were connected to the landline, but they have much better properties. And so the merge is all about, just to recap, upgrading this consensus layer, which gives you much better properties from a security standpoint, but it doesn't change the execution layer. And then it turns out there's these second order benefits, which must not be overlooked. Like the first second order benefit is that Ethereum as a system will be consuming much less electricity, roughly between 3 and 4 orders of magnitude. So between 1,000 times and 10,000 times less electricity. Roughly speaking, Ethereum today is consuming about 0.2% of all the electricity that's consumed in the world. So it's a small amount, but it's not negligible. One of the things that's kind of bad for Ethereum, if it were to stay with proof of stake, is that if it were to grow in value, if Ethereum were to become a $10 trillion system or $100 trillion system, then suddenly we'd be consuming, 10% or 20% or whatever it is of all the electricity produced and consumed in the world. So it's kind of a limit to scalability in a way. And then the other kind of very interesting second order effect is that this new engine is so much more economically efficient. So what does it mean? It means that you need way less incentive for the consensus participants in order to get the same amount of economic security. So another way to phrase that is basically that the cost per unit of economic security is reduced dramatically by roughly 30x. And so what is economic security? It's this idea that it measures the number of dollars that you need to go perform a 51% attack. So in proof of stake, that's right now about $22 billion, which corresponds to the 13.6 million ETH state. And so if you want to perform this brute force 51% attack, you need to come in with $22 billion worth of Ether to pull off this 51% attack. And you can ask yourself, like, what is the cost of all this economic security? Well, the cost is the issuance that we give to the validators. It's on the order of 3 to 4%, let's say. And that matches the opportunity cost of money, right? Like basically the scarce resource here is money. Money is locked in this virtual box while you're staking. You can't touch your money. It's placed as collateral. And really the cost for you as someone who provides this scarce resource is the cost of money, which is the opportunity cost of money, which is fairly small. On the other hand, with proof of work, the way that you estimate the total amount of economic security is by calculating how many dollars would it take to buy up all the hardware required to do a 51% attack. That includes the mining rigs, it includes the transformers and the racks and connecting everything to the grid. And you end up with a number close to, let's say, $5 billion. And so not only are we increasing the total amount of security from $5 billion to $22 billion, but we're also dramatically reducing the issuance, which are the incentives for these consensus participants to provide a scarce resource. So for proof of work, right now, every single day, we're minting out of thin air 13.5 thousand ETH. So every single day, we have this huge amount of sell pressure. At current prices, it's roughly $20 billion. And most of that ETH is being economically, the miners are economically forced to sell it. And the reason is that they have to pay for their electricity bills, they have to pay for their hardware bills. And post-merge, the total amount of issuance is roughly going to go down by a factor of 10x, or maybe a better estimate would be 8x. So it's going down from 13.5 for proof of work down to 1.7 thousand ETH per day only. And so one question you can ask yourself is like, what is the upgrade in economic efficiency? Well, it's going to be 8x less reduction in terms of the inputs to the engine. And then the output to the engine is economic security. That's 4 times larger. So 4 times 8, that's 32. And so our engine is roughly 32 times more economically efficient than the previous engine.
All the numbers have to be multiples of 32, I think. That's important. Yeah, and I mean, there's all these other benefits too around friction, right? Like if somebody wants to validate, i.e. mine the network, they don't have to buy up a bunch of hardware and start geeking out on being a professional miner. They can put their capital to work either with 32 ETH or through some fractional ownership through derivatives and, be able to stake and still achieve the yield. One thing around the math that I wanted to figure out, I'm sure you'll correct me if my math is wrong, but if you look at today's inflation, like what we pay to miners, I think it translates to something around 4 to 5%. And with the proof of stake system, that inflation is going to go down to closer to 0 to 1%. And then if you've got lots of transactions and you're burning ETH, then it might be flat or it might be slightly negative and deflationary, and therefore the ultrasound money narrative. So there is this very large, relatively speaking, reduction in the inflation rate. At the same time, the expected yield for stakers, I've seen a variety of estimates going anywhere from 3% all the way up to over 10%. So that's your interest rate, your opportunity cost of money. And that's composed of the inflation rate, and then I'm guessing the rewards from transactions, and then maybe potentially capturing some MEV stuff in there. But I wanted your help on kind of squaring the 0.5% inflation that the network is performing or that minting versus the, let's say, 3 or 4% of yield that a staker gets. Like, how do you bridge that? How does that make sense?
Right. So you're right that the total amount of issuance is roughly on the order of 0.5% of the whole supply, right? So just to make the math easy, let's just say that's 100 million ETH, and 0.5% would correspond to 500,000 ETH that's issued every year. Now, the question is, how many stakers are there? And it turns out that not everyone's staking, right? Right now, there's let's say 10% of all the ETH that's staking. And so this small 10% is getting all the issuance for themselves. And so that's going to amount to much, much more than 0.5%. Yield is going to be 0.5 times 10, right? Because only 10% is staking. So that roughly matches the 5% yield, give or take, that we're observing today. Now, you're right that at the merge, the validators will get to build the blocks. And as part of that, they'll get to capture the value in the block building process, which is composed of two components. The first one is what we call the tips, which is basically the transaction fees which are not burnt. And the other part is, as you said, the MEV. And so we could see, temporarily the APR spike, to 6, 7, 8, maybe all the way up to 10%. It's going to basically depend on this fee market, which is fairly volatile and fairly correlated with bulls and bear markets. So if we enter a new bull market and transaction fees, start ramping up again, then we could easily see, a 10% APR for validators. But what will happen most likely is that the more ETH will come in and stake and kind of arbitrage down this APR to the opportunity cost of money. And so if let's say the opportunity cost of money is, let's say, 5%, then we should expect ETH to come in such a way that the APR is brought down to 5%. So more validators come in means that all these fees have to be split across more validators, and so the APR per validator decreases as more staked ETH comes in.
Got it. Perfect. Makes sense. So the other side of the equation is the demand side, and it certainly drives transaction fees and gas and so on. But I want to connect it to the next question about roadmap and where Ethereum's going. Because the demand side historically has been really the thing that's created the immense capital gains 10 times, 100 times, 1,000 times up. And then the similarly immense capital losses, 70% down, 80% down, depending on the cycle. And that's because people have budget to spend. There's consumer discretionary spending from the various distributions from governments, and then contraction from interest rates and the macro environment and inflation and so on. And it also connects to how much people actually want to use Web3. Like, what is there to do on Web3 that is worth their discretionary spending? So while I think the supply side's fantastic and really important, and once Ethereum is at a $10 trillion sort of global computational money supply place, it'll probably be the dominant dynamic. Right now, the demand side is still extremely important. And so for the demand to come and for people to be interested, Web3 needs a whole bunch of things, and Ethereum needs a whole bunch of things like scalability, like composability and integration, like applications. Can you talk a little bit about what's next after the merge is implemented in order to make the protocol that attracts all this economic activity? Like, what are the important bits that you see?
The way that I think of the demand side of ETH is in two completely different buckets. So bucket number one is this idea of demand for ETH for transaction fees. And with EIP 1559 and with this idea of the fee burn, one of the amazing things is that now, Ethereum is actually capturing to a very large extent these transaction fees. And so that means that you can think of Ethereum almost like a tech company, right? It has income and it has expenses, and ideally it has some amount of profit. Now, what is the income? That's going to be the transaction fees which are burnt. What is the expenses? That's the issuance that it has to provide to pay for security, to pay for economic security. Once you have these two cash flows, income and expenses, you can start looking at P ratios, just like you would for a traditional company. And you might come up with a certain valuation for Ether, and there's this website ultrasound.money which actually allows you to play with this P ratio. There's this other aspect of Ether which I think is currently heavily kind of underappreciated, is this idea of monetary premium. Is this idea that ETH might be used as money, and specifically collateral money or store of value, just like Bitcoin. So where is ETH used as money? Well, right now it's used in at least two places. First of all, it's used as collateral money in the context of staking, right? We have, give or take, let's say 10% of all the ETH supply, which is staking. And we also have ETH used as collateral money in the context of DeFi. So for example, it's a collateral in Maker in order to mint DAI, the decentralized stablecoin. And so, if you zoom out, roughly speaking, right now, there's about 15% of all the ETH supply, which is used as collateral money. And my expectations is that over the long term, the vast majority of ETH will be used as collateral money in a way that's what it's optimized for. And so you can ask yourself, should ETH accrue monetary premium? And I think the best analogy that we have here is actually gold. So gold has this similar dual purpose. On the one hand, it has utility as an industrial metal, right? It's used in every single iPhone, in every single piece of electronics, and for all sorts of industrial use cases. But at the end of the day, the total amount of gold which is used is like a small portion of its supply, let's say 10% for the sake of argument. Now, if you try and come up with a valuation for gold based on cash flows, and its use as an industrial metal, you might come up with a valuation on the order of $1 trillion. But if you look at the actual market cap of gold, it's closer to $10 trillion. And so you might ask yourself, where does this extra $9 trillion of value come from? And it's this kind of this funny concept called monetary premium. Is this idea that as a society, we have this societal illusion, we've created this narrative, and we've come to consensus that this one special asset, gold, is worthy of monetary premium. And gold is basically used as this store of value, and is locked up in vaults underground by various central banks and other entities. And so the vast majority, let's say 90% of all the gold is used as money. And I think a similar story will happen for Ethereum. So there's going to be, let's say, 10% of all the ETH supply, which is going to be extremely high velocity, right? It's ETH that's sloshing around at a very high pace, and contributing to a lot of transaction fees and a lot of burn, and to very favorable cash flows in terms of Ether as a system, gaining this income. And on the other hand, you're going to have this, maybe let's say 90% of the ETH supply, which is ultra low velocity. It's just sitting there and not moving for years and years and years, potentially decades and decades. And the reason it's not moving there is that it's locked in this digital box as a form of collateral, either in the context of staking or of DeFi, or of people who just want to use Ether as a store of value. And so my personal belief is that we could maybe expect, just like gold, like a 10x monetary premium on top of the quote fair valuation from cash flows alone. And the question is, why do we even want monetary premium? Is it like just so we can pump our bags? And the answer is like, no, not at all. Like, monetary premium, in my opinion, is fundamental to the mission of Ethereum, which is to become a settlement layer for the Internet of Value. So if we are going to become a settlement layer for the Internet of Value, we need two things. One is that we need this best-in-class economic security. So as I mentioned earlier in the podcast, we will have roughly $22 billion of economic security post-merge. And that's a pretty good number, but $22 billion is like peanuts in the grand scheme of things, especially for very big attackers, potentially like nation states, right? Nation states, they operate on the hundreds of billions of dollars. That's kind of the order of magnitude for the annual military budget of some of these large nation states. And so really we want to be in a position where we have trillions of dollars of economic security, so that it's like, almost unthinkable for a nation state to even, start attempting to attack Ethereum. So that's where we want to be from an economic security standpoint. And the only way that we can get there is through monetary premium. Cash flows alone would there's just not enough cash flows to get there. Now, the second reason why we want monetary premium is this idea of economic bandwidth. So if we want to settle the Internet of Value, there needs to be lots of value out there. And one of the key aspects of the Internet of Value is decentralized stablecoins. And these decentralized stablecoins, they're extremely hungry in collateral. And the best form of collateral, the most pristine form of collateral, is Ether, the asset itself. And so if we want to have trillions of dollars of stable coins, just like we have trillions of dollars of actual, US dollars and, euros and yen and all of these things, if we're going to create this financial ecosystem on top of Ethereum, then we're going to need trillions of dollars of stable coins. This is non-negotiable. And so we're going to need trillions of dollars of economic bandwidth, namely this pristine collateral. And again, the only way that we can get there is through ETH accruing monetary premium.
I've got two questions for you that I'm going to ask in reverse order because I want to pull on the sort of economic value thing a bit more. But I think the two questions are connected, and they're around, roadmap, scalability, and in particular, like the interaction of the scalability of the core network that maybe happens through sharding after the merge is done, and then the interaction with other EVM compatible layer ones, and then the layer twos and the rollups and all the stuff that's kind of has been a scalability. It's unfair to say band-aid, but sort of like a bridge towards scalability. So I want to handle that question last. And the thing I want to put before it to connect to your economics discussion is, like, let's assume that kind of all the pieces you've described are as they are, so that you've got 90% of people staking, maybe 80% within Ethereum staking, and then 10% locked up in the rest of DeFi, which is sort of roughly how the numbers are today, if you look at comps. And then the 10% that's left is this like high velocity payment system for, payment for transactions. So supply and demand for transactions. And then the number of transactions is related to the economic activity within Web3, which requires gas. And now let's assume that scaling happens through all the methods. And so it sort of asymptotically goes to infinity. Like the space for decentralized computation and for being able to stuff software into Web3, like that constraint's just kind of floating away the further we get with technology. And so in a sense, the intuition would be is the more capacity you have, the lower the price, because there's just less competition for that block space. Today's price for transactions is very high because the throughput is so small. But, going from like Real Player to YouTube is a huge, huge step. And it costs nothing now to upload the marginal YouTube video. Whereas with Real Player, every video is like such an immense thing. And so similarly, you would think that if you've got infinite supply of decentralized computation, the price is going to trend towards zero, and the price of it would trend towards zero. And that has implication for, like, is there value or should there be quote unquote value in a protocol token? Or do we want a world where this is like a free commodity infrastructure? Like, is that the world that we end in? So let me sneak in that question before we get to like a reality check on the scalability. But does what I outlined make sense as a proposition?
Right. So this is a very common point this is brought forward. What is basically the dynamics between scalability and fees? And it turns out that there's two separate concepts of fees that are worth distinguishing. One is the per transaction fee. So you make one transaction, how much do you have to pay for this one transaction? And then the second concept of fees is what I call fee volume, which is the aggregate fees over all the transactions. And so fee volume is just the per transaction fee times the number of transactions. Now, what do we want here? We want very, very low per transaction fee, right? We want as many people to be using Ethereum as possible. We want the UX of it to be very, very low. And what we want is high fee volume, right? Because high fee volume is this income for Ether. It's this valuable cash flow. And it turns out that we can have the best of both worlds. We can have both simultaneously. And how do we get there? We get there by having lots and lots and lots of transactions. And so, your YouTube analogy might be a good one, actually. It's extremely cheap to go upload a YouTube video. I mean, it looks free to you as an uploader, but it's actually not free, right? YouTube actually has to go ahead and pay whatever, like a few cents in bandwidth and storage and whatnot to host your video. And so they might have like this tiny income per view, but there's like so many views that, at the end of the day, YouTube is like one of the most profitable, endeavors in all of human history, right? It's worth, hundreds of billions of dollars. And I think this is where we're headed. We're basically headed to a point where to make a transaction is going to be almost negligible to you, let's say 1 cent, but there's going to be millions and millions of transactions per second. you might ask yourself, does the scalability roadmap technically allow for this, right? Aren't blockchains like fundamentally scarce resources that don't scale? And it turns out that, we've made huge leaps and bounds from a research standpoint. And just to give you like the big zoomed out picture, where we are now, if we just look at Ethereum layer 1 throughput, we're on the order of 10 transactions a second, which is definitely not enough for a settlement layer for the whole Internet of Value. The good news is that we have a 100x improvement, which is unfolding, as we speak, around rollups. So the idea of rollups is that you only put the transaction data at the layer 1, and you don't do any of the transaction execution. Instead, the transaction execution happens off-chain, at a much, much, much cheaper cost, using either fraud proofs or these fancy mathematical proofs called SNOCs. But the important thing to understand from an economic standpoint is that you're only putting in this data, and not only do you only put the data, but you can also compress it. And you get roughly 100x scalability to 1,000 transactions a second. Now, the next 100x is called sharding. Is this idea that the validators, those participating in consensus, they only have to download very small slivers of the data that goes on chain. Like traditionally, like the naive brute force approach is that every single validator downloads every single byte that goes on chain. And that's obviously non-scalable because it means that you're basically limited by your best internet connection. And we want validators to be validating from home on a home internet connection. And so you're kind of fundamentally limited by one home internet connection for the whole world. And that's obviously not going to work. And so the way that we solve this is with this idea of sharding, where you basically only download, let's say, 1% of all the data that goes on chain. And that's enough to guarantee the security of the system with like fancy cryptography and fancy cryptoeconomic systems. So this other 100x gives us 100,000 transactions per second, still with like the best in class security that we want for the settlement layer for the Internet of Value. And then there's this other 100x which we can hope for, which is basically this idea of Moore's law but for bandwidth. Right, so Moore's law says that the density of transistors kind of increases exponentially. Well, there's this other law called Nielsen's law, which says that bandwidth grows 50% every year. And there's good reasons to believe that this observation, which has held true for 30 years roughly, is going to hold true for another decade. And if you compound 50% every year over a decade, you roughly speaking get 100x. And it turns out that if you look at the fundamentals of blockchain computational, bottlenecks, there's four of them that potentially come into play. One is CPU, another one is storage, another one is bandwidth, and the fourth one is a subtle one called disk I/O, which is basically how fast you can read and write random bits and bytes in a large disk. Now, it turns out that the bottleneck today is disk I/O, but this bottleneck, along with the storage bottleneck, is going to go away with a technology called statelessness. It's this idea that as a validator, I don't need to have the state. Right now, the Ethereum state is on the order of 100 gigabytes, and it's very intensive on disk I/O, meaning that you're constantly reading and writing, and you're maxing out your throughput on your disk. And statelessness kind of automagically, with fancy cryptography, removes both these bottlenecks from the equation. And then there's this other bottleneck, which I mentioned, which is just CPU time, like just doing the computation of executing the opcodes. And it turns out there's this very fancy cryptography called SNOCs, which basically allows you to have these mathematical proofs that proves to the validators that the blocks are valid. So it's not like the validators have to check themselves that they're valid, but they're kind of told that they're valid, and they can check the validity of these blocks in like just milliseconds, as opposed to, hundreds of milliseconds or even whole seconds. And so you're basically removing CPU as a bottleneck there. And then you're left with the one fundamental computational bottleneck in blockchains, which is bandwidth. And the good news is that bandwidth just grows 50% a year. And so the end game, if you add this extra 100x on top of sharding and rollups, is you get to 10 million transactions a second. And it turns out that 10 million transactions a second is enough for every single human on Earth to make 100 Ethereum transactions per day. My thesis is that assuming we can pull through the scalability roadmap over the next decade and get to 10 million transactions a second, then it's going to be winner take most. Basically, it's going to be this one blockchain that's going to serve as a settlement layer for the whole Internet of Value. You alluded to like these competitors to Ethereum. I don't think that there will be much competition. I think it will be winner take most, at least for this one specific thing, which is settling the Internet of Value. There will be all sorts of potentially other blockchains that do other things. So one of the great examples that's complementary to Ethereum here is Filecoin. Is this idea that if you want to build a decentralized application in the context of Web3, you need settlement. That's one thing, but you also need like large amounts of storage. So for example, if you want to build a decentralized Twitter or decentralized YouTube or Facebook, like you need a place to go dump your images, dump your videos, dump your tweets. And that's what Filecoin is optimized for, and something that Ethereum is not at all optimized for. And so like these two blockchains combined will be kind of building blocks to build these more complex Web3 applications.
That's fantastic. You've masterfully answered all of the questions in a very coherent narrative. So thank you for that and for opening up these really complex topics in such an approachable way. Justin, really appreciate your coming onto the podcast. If our listeners want to learn more about you, to learn more about Ethereum and the merge, where should they go?
For me, you can find me at DrakeFJustin on Twitter. I have open DMs if you want to chat with me. I do take the time to read through the DMs. If you want to learn more about just Ethereum and the merge in general, I make a recommendation for some podcasts, basically. So one which is very good is called Bankless. Another one is called Into the Ether, even though that might have been discontinued. And there's also the Daily Way by Anthony Sassano. So that's how I actually learned a lot just by listening to podcasts and kind of this. I like learning while walking. But yeah, there's just so much content nowadays on this stuff. And if you're interested in kind of moving to the next level, from a learner to a builder, especially if you're interested in kind of more theoretical research, then there's this website called ETH Research, where a lot of the Ethereum research happens. And it's a good starting point if you want to get involved.
Fantastic. Thanks again for joining us today.
Thanks for having me, Lex.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.